There is something almost primal about gold, isn't there? I mean, it's not just a metal on the periodic table.
Oh, it's entirely psychological.
Right. It's the apocalypse asset. When the stock market is bleeding out, or inflation is eating your savings, or the news is just a constant stream of anxiety, the lizard brain wakes up and screams, "Get the shiny rock!"
Get the shiny rock. Yeah, that's exactly it.
It feels like the one thing that can't just evaporate into thin air.
It really is the ultimate panic button.
Right.
And it has that timeless allure because for thousands of years, it has actually been the money of last resort.
Mm-hmm.
But that emotional reaction, that lizard brain impulse you just mentioned, that is exactly where people get into trouble.
Right, because panic is rarely a good investment strategy. And that is exactly what we are digging into today for this deep dive. Because just because it's gold doesn't mean it's a smart move if you buy it the wrong way.
Exactly.
In fact, you can absolutely lose your shirt investing in the so-called safest asset on earth if you don't read the fine print.
And that is the reality check we all need today. For this deep dive, we are looking at a really comprehensive analysis titled Critical Gold Investing Errors to Avoid.
Right.
It's published by the Gold IRA Company's Bulletin. And the headline here is, effectively stop buying gold until you read this.
Which sounds like a bit of a cold shower for the gold bugs out there.
It is a cold shower, but a very necessary one.
So before we get into the nitty-gritty, tell us a bit about the brain behind this analysis. Like, who are we learning from today?
We are looking at the work of Doug Young. He's a heavyweight in this specific niche. He has over 20 years of experience in financial markets.
Okay.
But more importantly, he has spent the last 15 years specifically specializing in gold IRAs and precious metals.
That is a very specific focus.
Very specific. He's conducted over 80 detailed evaluations of gold IRA companies. So this isn't just some casual observer. This is someone who acts almost like an auditor for the entire industry.
So he's seen the plumbing.
He's seen the plumbing, the leaks, the sewage, all of it. He knows exactly how the contracts are written, and he knows the aggressive sales tactics that get used on unsuspecting investors.
Which is exactly what we need to unpack. So the mission for today is pretty straightforward. This isn't a how-to on getting rich quick. Think of this more as a survival guide for your portfolio.
I like that, a survival guide.
Yeah, we are going to walk through 6 specific traps that Doug Young identifies. Traps that inexperienced investors fall into all the time.
And what's fascinating here is that some of these traps don't look like traps at all.
Right. They look like normal investments.
They look like common sense. They look like convenient, easy ways to get into the market. But as the source material reveals, they can actually be massive financial dead ends.
Okay, let's get right into it. The first trap Young talks about is a timing issue. And honestly, this one surprised me a bit, because in the stock market, we were trained to be agile. You know, you buy a tech stock, it pops 10% in a week, you sell, you take the win.
Right, day trading mentality.
Exactly. But he says the first major error is treating physical gold like a day trade. Why can't someone just buy gold today and sell it next month if the price goes up?
Because that goes completely against the reality of physical commodities. We are so used to apps where you can click a button and trade instantly with 0 fees.
Yeah.
Young is arguing that you absolutely cannot treat physical gold that way. It really comes down to friction.
Friction. So what kind of friction? If I buy gold today and the global price, the spot price goes up next month, shouldn't I be able to just sell it for a quick profit?
You would think so.
Yeah.
But you have to factor in the spread. This is a concept Young emphasizes heavily in the bulletin. You have to understand that there isn't just one price for gold.
Right.
There is the spot price, which is the wholesale price for a massive 400-ounce bar sitting somewhere in a vault in London. You, the regular investor, cannot buy at that price.
Because I'm not a central bank.
Exactly. You're buying from a retail dealer. That dealer has overhead. They have minting costs, shipping, insurance, staff, security, and of course their own profit margin.
So they pass all of that on to me.
Yes. So when you buy a coin, you pay the spot price plus all those extra costs. That's called the ask price.
Okay, let's put some real numbers on it so we can visualize this. Say spot is $2,000. I might pay $2,100 or $2,150.
Right. But here is where the trap snaps shut. If you turn around the very next week or month to sell that coin back, the dealer isn't going to pay you $2,150.
Because they need to make money on the buyback, too.
Exactly. They probably won't even pay you the $2,000 spot price. They pay the bid price, which is the wholesale rate they can acquire it for.
So effectively, the second my transaction clears, I am instantly in the red.
You are immediately out of the money. You are underwater. To sell it back and just break even, The global price of gold has to rise enough to cover that entire spread, that whole gap between what you paid and what you can sell it for.
That makes perfect sense. It's exactly like driving a new car off the lot. You take that immediate depreciation hit, or in this case, a massive transaction cost hit.
That's a brilliant analogy. And Young points out that gold often goes through long periods of consolidation.
Meaning it just kind of trades sideways.
It trades sideways, it stays flat for a while, it's not always shooting straight to the moon.
So if I buy gold with money I need for next month's rent or a tuition payment in 6 months,
You are almost guaranteeing a loss. Even if the broader market didn't crash, you lose money simply on the spread. The source is very clear on this rule. Gold requires a medium to long-term view. We are talking years, not weeks.
you need time for the organic growth of the asset to actually overtake those initial dealer costs.
Precisely. Never invest funds you might need to access soon.
Okay, so patience is the name of the game. Now let's move to the second trap. And this one addresses the convenience factor. I think a lot of us, if we want to invest in gold, we look at buying physical bars and think, well, where am I going to put this? Do I need a safe? Is it heavy? It feels like a massive hassle.
It is a logistical challenge for sure. You're dealing with a physical object in a very digital world.
So the obvious solution seems to be, why not just buy a gold ETF? Specifically, the source mentions the GLD ETF. It trades like a stock. It tracks a gold price. It sits right in my brokerage account. It seems like the perfect modern solution. But Doug Young is waving a massive red flag here.
A massive red flag. And this is where we really have to look at the fundamental difference between price exposure and actual ownership. Young warns that investing in an ETF like GLD is entirely different from owning the metal.
How so?
When you buy the ETF, you are just holding a piece of paper or a digital entry on a screen. That entry represents a claim on a trust.
But the trust owns the gold, right? So indirectly I own it.
Ideally, yes, the trust has the gold, but your legal relationship is with the trust, not the gold itself. This introduces what we call counterparty risk. Young notes that if you actually sit down and read the prospectus, the fine print that nobody ever reads it is almost always written entirely in the trust's favor.
Written in the trust favor is never a phrase you want to hear when we're talking about your life savings.
No, it's terrifying. The source dives into the mechanics of this. In a normal sunny day market, everything works fine. The price tracks, you can buy and sell your shares easily. But in a catastrophic market failure, which, let's be honest, is usually exactly why people are buying gold in the first place, the trust has out clauses.
What kind of out clauses?
Well, specifically regarding redemption, Young explains that unless you are what they call an authorized participant, which basically means a massive Wall Street institution dealing in millions of dollars, you cannot trade your retail shares for actual physical metal. You can't just call up the GLD hotline and say, hey, send me my gold.
So I'm stuck with the paper.
We are stuck with the paper claim. And here is the really scary part. If the financial system really breaks down, or if there is a severe global shortage of physical metal, the trust often has the legal right to just settle your claim in cash.
Wait, hold on. Let me get this straight. If the dollar is collapsing and I specifically bought gold to protect myself from the dollar collapsing and I want my value, they settle me out in dollars.
That is the ultimate paradox. You are handed back the very currency you are desperately trying to hedge against.
So the entire reason you bought the gold to have a safe haven completely outside the banking system is negated because you bought it through the banking system.
That is exactly the irony Doug Young is highlighting. His advice is stark. Physical gold minimizes this because you eliminate the counterparty risk altogether. If you hold the physical coin in your hand, you don't need a trust, you don't need a custodian, and you don't need a bank to fulfill a promise. You actually own the asset.
It's the difference between holding the deed to a house and holding a ticket that says, we owe you one house, subject to availability.
Exactly. Or we owe you the cash value of a house as determined by our lawyers.
Yikes. Okay, point absolutely taken. Physical is safer for the long haul because it removes that counterparty risk. So let's say I'm convinced. I want physical gold. I walk past a high-end jewelry store window and I see a beautiful 24-karat gold necklace. I think, perfect. It's real gold, it's valuable, and I can wear it to a nice dinner. But Young lists this as the third major error.
Yes, the jewelry trap. This is a remarkably common misconception. People confuse consumable luxury goods with investment assets.
But it is gold, right? If it's 24 karat, it's pure.
It is pure gold. But think about what you're actually paying for at the register. When you buy that necklace, you aren't just paying for the raw weight of the metal. You are paying for the artistry, the brand name, the marketing campaign, the retail markup, The store's expensive rent on Fifth Avenue.
The labor of the artisan who made it.
Exactly. The premium over the gold spot price on retail jewelry is massive. We're talking sometimes 200 to 300% over the actual value of the gold. Young points out that jewelry value is intrinsically tied to fashion trends and craftsmanship.
Right.
But if you try to sell that necklace later as a financial investment, the buyer, say a standard gold bullion dealer, doesn't care about the luxury brand or how pretty the clasp is.
They don't care that it's a designer piece.
Unless it's a breathless historical antique. Generally, no, they do not care. They only care about the melt value. They are buying it to toss it in a crucible and scrap it. So all that extra money you paid for the art, it evaporates the second you walk out the store doors.
So you paid for the art, but you're only selling the metal.
And that creates a mathematically terrible return on investment, a terrible ROI. You effectively lose all that craftsmanship value instantly. It's just not an efficient vehicle for wealth preservation. His advice is to buy jewelry because you love it and want to wear it, not because you think it's your retirement fund.
Okay, so jewelry is a dead end for investing. But what about coins? And I don't mean just standard coins, I mean the rare ones, the old ones. Numismatics, I see ads for these constantly. You know, rare Civil War era gold discovered in a shipwreck. It feels like you're getting the gold plus this amazing historical value. Doesn't rarity equal higher value?
In the high-end antique world, sure. But in the investment world, for the average everyday person, it's an absolute minefield. Young explicitly calls this sector the domain of bandits.
Bandits. That is really strong language for financial analysis.
It is strong, but he completely justifies it. The source warns that the rare coin market is absolutely rife with fakes, forgeries, and vastly overpriced items. The core problem here is something called information asymmetry.
Meaning the dealer simply knows more than I do.
Much, much more. The dealer knows exactly what that coin is really worth, how it's graded, and what the true liquid market for it is. You as the learner probably do not. You see a shiny old coin and hear a cool dramatic story about the Civil War.
Right, I wouldn't know how to accurately grade a coin from 1890. I can't tell the difference under a microscope between a mint state 65 and a mint state 63.
Exactly. But the price difference between those two tiny grades could be thousands and thousands of dollars. And because you don't know that, you are a prime target. Young warns that scammers love numismatics because the value is highly subjective. They can tell you, hey, this is worth double the gold price because it's super rare, and you have no easy, quick way to verify that claim. You might end up buying a coin for $5,000 that contains only $1,500 worth of actual gold, just hoping the rarity holds its value. And often, it simply doesn't.
There's another specific tactic Young mentions with these rare coins, too. The confiscation script. I've actually heard this one before on late-night radio.
Oh, this is the classic fear tactic in the industry. The shady dealer will get you on the phone and tell you the government is going to seize all the standard bullion bars just like they did back in 1933. But wait, these rare collectible coins are exempt. They are safe from the government.
Is there any actual truth to that?
It's marketing nonsense explicitly designed to upsell you. They push the rare coins because the profit margins for the dealer are absolutely huge compared to standard plain bullion. They're using historical fear to push you into a product that makes them rich, not you.
So if jewelry is bad because of the retail markup and rare coins are bad because of the massive fraud risk and the bandits, what on earth are we supposed to buy? What is the Goldilocks option here?
The source is very specific on this exact point. You need to stick strictly to standard government-issued bullion coins.
Okay, give us the specific examples. What should we actually be looking for?
Young lists the absolute classics, the American Eagle and the Canadian Maple Leaf.
And why are these two the safer bet?
Because they are pure commodities. A 1-ounce American Eagle is a 1-ounce American Eagle anywhere on the planet. It's recognized globally. You don't need an expert historian with a magnifying glass to appraise it.
Right.
The pricing is completely transparent. It's just the daily spot price of gold, plus a very small standard manufacturing premium. You know exactly what you're buying. And more importantly, when you eventually go to sell it, the dealer knows exactly what they are buying.
It's highly liquid.
It's extremely liquid. You can sell an American Eagle in New York, London, or Tokyo almost instantly. Try doing that with some obscure commemorative coin from the 1800s. You'll spend weeks just trying to find a buyer who cares.
So boring is actually good.
In investing, boring is usually very, very good. You want the raw asset, not the dramatic story attached to it.
This leads us right into the darker side of the industry that the source touches on at the end. We talked about bandits and wear coins, but there's a broader issue of just straight up scams, the too good to be true rule.
Yes, as gold has become more popular during these turbulent economic times, it has attracted a massive swarm of predatory actors. Young highlights the aggressive marketing tactics we're seeing right now, specifically cold calling.
Yeah, I think we've all gotten those random calls or seen those late night commercials. Buy gold now, guaranteed 50% return. Or the one that always gets me is get gold at below market rates.
And that right there is the ultimate trap. The source explicitly mentions that if someone is cold calling you, offering a deal that sounds wildly lucrative like selling you gold below the spot price, it is almost certainly a scam. There is simply no free lunch in global commodities.
Right.
Gold has a highly publicized daily market price.
Mhm.
Why on earth would anyone sell it to you for less than they could instantly sell it for on the open global market?
That's such a great point. If gold is trading at $2,000 and a guy on the phone offers it to you for $1,500, he isn't just being a generous guy.
No. They are likely stealing your credit card number, or they are running a classic Ponzi scheme where they use your new investor money to pay off the old investors, or worse, they're literally selling you gold-plated lead. The scam economy in precious metals relies entirely on the investor not doing their homework. They rely on you getting overly excited or overly scared and making a rapid snap decision.
So how do we actually defend against this? Because the source mentions that even legitimate gold companies are worried about this stuff because it gives the whole industry a terrible name.
Verification. It sounds boring, but it's the only real shield you have. Young emphasizes intense due diligence. You need to buy from reliable, verified, recommended sources. He mentions that reputable companies actually actively try to expose these fraudsters to protect their own industry's reputation.
So if you're looking at a new company, you should be checking how long they've been around, their independent reviews, their ratings, all that basic stuff.
Absolutely. You want a company with a long, verifiable track record. You want total transparency on fees. If a company is aggressively pushing you into weird, rare collectibles or promising returns that easily beat the stock market, just hang up and run the other way. The source makes it crystal clear that diligence isn't just nice to have. It is literally the only thing standing between you and counterfeit metals or your money just vanishing.
It really seems like the overarching theme of Doug Young's entire bulletin is stripping away the noise.
I think that's a perfect way to put it.
Let's try to synthesize all this for the listener. We started with this primitive idea that gold is super simple. You buy a rock, you hold a rock. But we've learned today it's actually quite complex if you aren't careful. To invest successfully based on this analysis, you actually have to actively ignore a lot of things.
You have to ignore the beautiful jewelry store window. You have to ignore the digital convenience of the paper ETF. You have to ignore the high-pressure sales pitch for the rare exclusive coins. And you absolutely have to ignore the short-term panic buying or selling mentality.
It's almost like a philosophy of pure investing.
It really is. The core philosophy here is truly understanding ownership. If you are buying gold to protect your hard-earned wealth, you need to actually own the wealth. Physical, standard, long-term holdings are the absolute only path the source recommends to truly mitigate your risk. Everything else we talked about today just introduces a middleman, a massive markup, or a gamble that totally dilutes the very safety you were looking for in the first place.
And I think that distinction between mere price exposure and true physical ownership is the biggest takeaway for me. I can play the gold market on my phone app, but that's not the same thing as having a true safe haven.
Not at all. And if we
Uh,
connect this back to the much bigger picture, think about exactly why people buy gold. They buy it as ultimate insurance against systemic failure. They buy it for the absolute worst case scenario.
Right. The zombie apocalypse fund, or maybe just the hyperinflation fund.
Exactly. So here's a really provocative thought to mull over based on everything we've discussed today. If that financial system actually breaks down, if the big banks falter or the national currency collapses, which is the very fear driving this investment, and your gold is just a digital line item in an ETF prospectus, or it's stored in some distant trust vault you legally don't have access to, do you actually own anything at all?
Wow. That is a truly chilling thought. You're essentially using the very system you don't trust to bet against the system.
Precisely. And if the system fails, your bet just fails right alongside it. That's exactly why physical possession of standard boring bullion is the ultimate recommendation. It's the only financial asset on earth that doesn't fundamentally rely on someone else's promise to pay you.
Well, on that slightly terrifying but incredibly illuminating note, we are going to wrap up this deep dive. It's been a lot to process, but I feel much better equipped to spot the sharks in the water now.
It's always a pleasure to dig into the complex details and look under the hood of these markets.
For those of you listening who want to verify the sources we use today, compare legitimate companies, and actively avoid the scams and bandits we talked about, the source material directs you to a very specific resource. You can find all the deep comparisons and read the full bulletin over at goldaircompaniescompared.com.
It's definitely worth a look to make sure you're finally on the right side of the trade.
Absolutely. Stay curious, keep digging for the objective truth in your investments, and we will catch you on the next deep dive.